Hello everyone, myself Sir Devendraprabu, Assistant Professor, Department of Commerce, KSR College of Arts and Science for Women, Tirchanur. So welcome to video. In this video we are going to discuss for income tax law and practice. In this we are going to discuss for capital gain. Fine. So capital gain is the part of the income tax. Majorly income tax comes under the category of various of 5 sources of income. Then business or profession, income from salary, then house property, then any other sources like that. In this one, we are taking the part of capital gain. We are discuss the meaning of capital gain. Under section 45, capital gain means any profit or gain arising from the transfer of a capital asset effected in the previous year shall be chargeable to income tax under the heads capital gain and shall be deemed to be the income of previous year in which the transfer of the took place. Profit or loss arising from the transfer of capital gain asset is taxable under the heads of capital gain. It is the fourth head of income. The capital gain is the previous year you have to purchase for any asset like securities, bonds, debentures, whatever the asset we have to purchase, that all assets are comes under the category of the capital gain. For example, I am the investor. I invested various sources or various platforms like through bonds or equity or any other securities. I have to get a receive from that on that income. That income will be treated under the category of capital gain. Right. The next one is we discuss the meaning of capital gain. The increase in the value of an asset relative to the price was originally paid for it. This is for capital gain. Then capital gain tax, a tax paid by an investor upon selling their asset based on the amount by which is asset appreciated during the time is yielded. So this is the difference between the capital gain and the capital gain tax. The next one is the capital gain was splitted into two types in majorly. The first one is short-term capital asset, then another one is long-term capital asset. Okay. The short-term capital asset means any capital asset held by an assessee for the less than 36 months will be termed as a short-term capital. That means the asset value should be not exceed more than 36 months. That means 3 years, within 3 years. That asset comes under the category of short-term assets. Then long-term asset means any capital asset held by an assessee for more than 36 months will be termed as a long-term capital asset. And this is for sales proceeds, then purchase of index and long-term securities. This all are the comes under the long-term capital assets. Okay. The next one is we have to going to discuss for the sections 54, 54 EC and 54F of the Income Tax Act. Section 54 deals with the exemption of an sale of residential property. Okay. It provides a tax exemption of capital gain when selling a residential property and reinvesting the procedure. This is comes under the section 54. Then section 54 EC, exemption through investment in specified asset. That means it allows individual to claim the tax exemption by investing a capital gain in specified assets such as an NHII and registered bonds. The next one is section 54F, the exemption on sale of any asset and then residential property. So an offer tax, then exemption of sale of long-term capital assets except residential property when the proceeds are reinvested in the residential property. Okay, so these are the major exemption for 54, 54 EC and 54F. Okay. The next one is computation of total income. We know that what is meant by income. We are earning any money or any income from our business or salary, that is called the income. And any income, if any assessment here, the taxable income companies for the following types of income. It comes under the following categories: salaries, income from house property, capital gain, business or profession, income from other sources. So these are the major income of our capital assets. So thank you so much. Thank you for watching video.